Okay, picture this. It's 1973, and a book comes out with an idea that's so simple, but so radical that it completely shakes up Wall Street. That book was Burton Malkiel's A Random Walk Down Wall Street, and it didn't just give some friendly advice. No, it kicked off a revolution that completely changed how we think about investing forever. So, when Malkiel first suggested that maybe, just maybe, investors should just buy a simple index of the whole market and just hold it, that's what the Wall Street pros called it, guaranteed mediocrity. I mean, you can see why, right? They saw it as a direct attack on their whole business model of charging high fees to pick stocks. But as we're going to see, this so-called mediocrity turned out to be a way better strategy for millions of people. Now, to really get why Malkiel's idea was such a big deal, you gotta remember what the world of investing was like back then. It was completely dominated by these high-commission brokers and fancy fund managers, and they were all promising they had the secret sauce, the special insight to beat the market and make you rich. And it all really boiled down to this one central question that Malkiel decided to tackle head-on. Are these experts really experts? Can anyone, and I mean anyone, consistently predict the wild swings of the market? And maybe most importantly for you and me, are their crazy high fees actually worth paying? Malkiel's answer to all of that was a very clear, very loud no. So if the experts couldn't beat the market, what was the alternative? Well, Malkiel proposed something so simple it was almost offensive to the establishment. An idea that basically challenged the entire game of picking individual stocks. He called it the random walk hypothesis. The core idea is that a stock's next move has absolutely nothing to do with its last move. Think about it like a drunkard stumbling home. You know where he started, but you have no earthly idea where his next step is going to land. Or even simpler, a coin toss. Just because it came up heads 5 times in a row doesn't mean tails is due next. Malkiel said, yep, the market works just like that. But that just leads to the next question, right? Why is the walk random? Well, the answer lies in another really powerful theory, the efficient market hypothesis, or EMH. This basically says the market is so incredibly good and so fast at processing information that any new piece of news is almost instantly baked into a stock's price. So by the time you read about it, it's already too late to act. And this theory gets even more solid when you break it down. You've got the weak form, which says looking at past price charts is useless. Then there's the semi-strong form, which says even analyzing public financial reports won't give you an edge. And finally, the strong form argues that not even illegal insider info can guarantee you'll win. The bottom line through all of this? In an efficient market, you can't get a higher return by being smarter. The only way is by taking on more risk. Okay, so if we accept that the market is mostly random and efficient, what does that mean for how people try to pick stocks? Well, it means the traditional methods are basically built on a foundation of sand, and Malkiel just goes ahead and dismantles them, one by one. He looked at the 2 main schools of thought for predicting the market. First, you have technical analysts, the chart gazers. In Malkiel's view, they're basically reading tea leaves. If the walk is random, any pattern you think you see is just an illusion. Then you've got the fundamental analysts, who try to calculate a stock's true worth. Malkiel thought this was, a bit more respectable, but he argued it was still flawed because, honestly, who can really know a company's true value? Plus, human psychology and emotions are constantly throwing a wrench in any rational calculation. And the data? Oh, the data is just overwhelming. You look at almost any long stretch of time, and the vast majority of professional fund managers, these are the people paid big bucks to pick winners, they actually fail to beat a simple market average. They underperform. And the reasons why are actually pretty simple. First, those high fees they charge act like a constant drag on your returns year after year. Second, even if a manager has one fantastic year, that success is statistically no more likely to repeat than a coin landing on heads again. A lot of the time, it's just plain luck. So if trying to outsmart the market is a fool's errand, what are you supposed to do? This is where Malkiel shifts from tearing things down to building a clear, actionable plan that pretty much anyone can follow. First, he really drives home the magic of compound interest with this awesome little mental shortcut, the rule of 72. All you do is divide 72 by your expected annual return, and that tells you roughly how many years it'll take for your money to double. So, at a 7% return, about 10 years. At 10%, it's just over 7 years. It's such a powerful reminder that time in the market, not timing the market, is your single greatest ally. And here it is, the core of his practical advice. It's so simple. 1, don't put all your eggs in one basket. Diversify across everything. 2. Invest the same amount of money on a regular schedule. That's called dollar cost averaging, and it really smooths out the market's bumps. And 3, every so often, rebalance your portfolio to make sure you're still on track with your goals. That's it. Simple, disciplined, and incredibly effective. But hang on, there's an elephant in the room, right? If the market is so efficient and random, how on earth do you explain superstars like Warren Buffett, who have consistently crushed the market for decades? It's the biggest, most obvious counterargument, and Malkiel tackles it head-on. You see, the two philosophies are just built on a totally different belief about how the world works. Malkiel says the market is mostly efficient. Buffett, on the other hand, believes the market can be irrational, creating amazing opportunities to find great companies for cheap. It's really the difference between being a passive passenger on the market's ride versus being an active hunter, searching for hidden value. Ultimately, it just comes down to trade-offs. Passive investing gives you super low costs and helps take emotion out of the equation, guaranteeing you'll get the market's return. Active investing aims for the stars, but comes with higher fees and the huge risk of making emotional mistakes. And Malkiel himself even admits that while the passive path is best for most of us, maybe, just maybe, in some less efficient corners of the market, a truly skilled active manager might have an edge. But the true legacy of Malkiel's work isn't just a theory in a book. It's the complete and total transformation of the financial industry. He didn't just write a book. He literally started a revolution. I mean, just look at this timeline. Back in 1973, the idea of an index fund was just bizarre. It was a weird academic concept. Fast forward through the 90s, the evidence starts piling up and they get more popular. And today? Today, trillions upon trillions of dollars are invested in passive funds and ETFs. What was once heresy is now the default choice for millions of investors all over the world. And that right there is his greatest contribution. He demystified finance. He wrestled power away from the high-priced gatekeepers on Wall Street and handed it back to the individual investor, giving us all a simple, proven, and low-cost way to build real, long-term wealth. So after all of this, the theory, the evidence, the entire revolution, it really just leaves you with one question to ask yourself. Is your own portfolio built to embrace the random walk, or are you still trying to predict the unpredictable?